A major theme in my book, Bank Regulation, Risk Management, and Compliance, is how a financial institution's business model creates compliance risk. Let me explain what I mean. What is a business model? A business model is how a company generates profit for its shareholders. The sector in which a company competes has a characteristic way of making money. And within this operating model, a company develops a unique competitive business strategy that differentiates its products or services in the marketplace. I'm interested in how business models create conflicts or tensions in less severe cases that create risk of loss. The most significant risk is compliance risk. Compliance risk is the risk of legal or regulatory sanctions, material financial loss, or loss to reputation from failure to comply with laws and regulations or codes of conduct. Compliance risk increases to the extent regulation conflicts or interferes with a company's business model, reducing its ability to generate revenue. A company must figure out how it can best mitigate these conflicts or tensions. To do so effectively, it must fully grasp the implications of its business model in order to tailor its policies and procedures and internal risk controls to address the model's unique risks. I'll give two examples, one from my experience at Moodys Investor Service, one of the major bond raters, where I spent most of my professional career, and the other from the banking industry. Most credit rating agencies are paid by their issuer clients to issue ratings. This is commonly known as the issuer pays model. Issuers buy their own ratings. This creates an obvious conflict of interest, which can jeopardize the reputation of the credit rating agency and cause it to lose business if the market perceives its ratings as biased. To make this concrete, imagine a newspaper that was paid by a company to write a news article about it. How can that article possibly be objective? After the financial crisis of 2008, Congress considered changing the bond rater's business model, but was unable to do so. However, as a compliance official at Moodys in the early 2000s, I helped design policies and procedures and internal controls around the ratings process to ensure objective and independent credit ratings. In order to build an effective compliance system, one must have a deep understanding of the company's business model and the risks that this business model creates. In this case, the loss of ratings independence and objectivity could cause reputational damage and financial loss to the credit rating agency. To mitigate this risk for Moodys, we created policies and procedures that broaden rating committee membership to ensure diversity of opinion, require data input from multiple sources in addition to the issuer, revamped industry ratings methodologies to ensure consistent assessment across all the issuers in a given sector, and revised rating analyst performance evaluations to include ratings accuracy. As an internal control, we established an information wall between the issuer fee sales group and the ratings analytics teams. Let's turn now to the example of banks and the compliance risk involving violation of anti-money laundering law. Banks' general business model involves liquidity transformation. In liquidity transformation, A bank obtains short-term funding from deposits, allowing it to fund long-term assets, which in most cases are loans. In a word, banks transform short-term liquid deposits into long-term illiquid assets. In doing so, they connect savers with borrowers by extending credit. In my view, a sharp tension exists between anti-money laundering law and banks' model of liquidity transformation. To understand this, let's dig more deeply into how liquidity transformation creates revenue for banks and how AML law interferes so directly with this business model. Increasing a deposit base is a big revenue generator for banks in three ways. First, attracting deposits is critical to banks as a way to ensure low-cost, short-term funding for various business activities. When banks grow their deposit base, they have short-term financing available to increase their lending capacity and implement other profitable business strategies. Loans, the other side of liquidity transformation, are a big source of banks' profit. Second, the more deposits a bank has, the greater its interest income from the spread between high-yielding loans and low-cost funding, which is known as their net interest income. Net interest income is a key indicator of bank profitability. Third, deposit accounts generate fee revenue from account maintenance and other payment services. Thus, increasing deposits has a threefold positive impact on banks' revenue generation: increased lending, net interest income, and non-interest fee income from account services. AML law creates a particularly sharp tension with banks' modes of generating revenue. The law requires banks to closely monitor their customers, and in certain cases refuse to open a deposit account because the account officers can't verify the customer's identity, or the customer's identity involves too much compliance risk. Another factor that exacerbates this tension are the costly compliance and risk management systems that AML regulation requires in order to ensure a bank is in compliance. In the final analysis, banks have a strong incentive to cut corners on compliance and open questionable accounts for their customers. I believe that AML's conflict with banks' business model and the high costs of AML compliance go far in explaining the notable compliance failures and multi-billion-dollar fines the banks have incurred over the last decade. I'm currently writing a book on anti-money laundering that will explore these issues and look forward to sharing it with the AML community.